Hey everyone, it's Chris here, and today I want to talk about real estate investment trusts and why I don't invest in them anymore. Better known as REITs, they are popular with dividend investors and retirees. And what's not to like about them? They take away the double taxation issues with dividends in general, and they tend to pay a pretty decent yield. So if you're looking to build income, they can be great investments. And if you stay till the end, I will show you a couple of small positions that I still maintain in some REITs, even though I no longer add to them. Now, before I explain my logic and the reason for the title, it's important to understand my situation. And even more, it's doubly important that you don't ever make a decision based on my circumstances, but on your own unique circumstances and needs. Now, first, both my wife and I are in our prime earning years. We've established ourselves within our particular industries, and with that comes a little bit higher income than a lot of other people. That puts us at a significantly higher tax bracket than it might put some of you. And this applies even more when we used to live in a state that had a marginal state tax return. So given this, let's talk about the first consideration for us, qualified dividends. When you look at most dividends paid by companies such as Apple or Pepsi and others, those are considered qualified dividends, while real estate investment trust dividends are not. Now, the reason this is important is qualified dividends are taxed like capital gains, while REITs are taxed at your marginal tax rate. So for us, married, filing jointly, the tax on qualified dividends can be anywhere from 0 and to a max of 20%. Now, our marginal tax rate, we haven't finished our taxes yet, sits somewhere between 22 and 32%, depending on where our tax rate comes out. And that doesn't even include state income taxes. So for us, there is a double whammy of paying significantly higher rates of tax right now, and when we retire and our income is lower, still having to pay income tax on those dividends. Realistically, we will earn probably less than $87,000 a year in retirement, which means based on current taxes, we will pay 0% on those qualified dividends we earn. So the old adage of don't put all of your eggs in one basket applies to the different asset classes you're investing in as well. Many people hold a significant portion of their wealth in real estate. And whether we're talking about a family home that has appreciated over the years, or if you own rental properties, most of us are already highly exposed to real estate. And that does include us, as we currently hold a single rental property that the value of that is probably higher than most of our portfolio. But it doesn't stop there. If you look at the S&P 500, you will see they own huge amounts of real estate. If you just think about, let's say, Walmart or Target or Best Buy alone, they own tons of real estate. And unironically, half of the most popular real estate investment trusts are renting property to S&P 500 companies already. So in many respects, I'm already heavily exposed to real estate, and I really don't want to increase that exposure anymore. Now, I will admit I'm a pretty conservative guy and don't like huge amounts of debt and leverage. And this has actually been kind of hard for me to adjust to, since now you can borrow at 2, 3, and 4% while earning on average a 7 to 11% a year. It makes it hard for me not to really take advantage and borrow on that. And yes, we have debt for this very reason. Why would I pay cash for something that we can earn more than the interest rate? And like most real estate investments, they do include a lot of leverage. Now, I was reading, as I did research for this video, that the average real estate investment trust has a debt ratio of 3.5 to 1. Now, you compare that to the S&P 500, the S&P 500 has a debt ratio of about 1.5 to 1. This makes them highly exposed to both turndowns in the market as well as increases in the interest rate. Now, obviously, the larger REITs tend to be better at managing it, and certain real estate types also have higher or lower debt ratios. So given all the above, I tend to stick with traditional stocks that pay qualify dividends. With the proper selection, your yield on cost can easily grow over time. In fact, one of my largest holdings, I have a yield on cost of 7.5% of qualified dividends. Now, like I said, at the beginning of this video, I do own a few shares in 2 different REITs, so let's talk about those. Now, Simon Property Group runs retail shopping malls, and what I like about Simon Property Group is they run a majority of the outlet style shopping malls. The big outlet malls you go to, and they have a Armani outlet and a Nike outlet and an Adidas outlet. They tend to be in areas of higher population density and also higher income areas. And during the last few years, even during the craziness that was going on, most were packed except for small periods of times of either downturns or when everything was completely shut down. Well, I think traditional malls are kind of dying. I think outlets will do just fine, especially given the tenant profile that Simon Property Group tends to have. Now, they currently yield 4.58% as I record this, and they've been increasing the dividends that they're paying out as things has recovered over the last 2 years. So my second holding is WP Carey, which is a large diversified real estate investment trust. When I say diversified, they're diversified in both the property types that they have, but also in their location. They currently have locations in the US, Canada, Mexico, Europe, and Japan, and they currently have a yield of 5.65% and tend to grow their dividend quarterly. So what do you think? Do you invest in real estate investment trusts? Do you love them? Do you hate them? Leave a comment below and let me know what you think. And if you can give this video a like or subscribe, I would really appreciate it. And thanks for watching. I'll see you in the next video, and bye for now.